Well, joining me now virtually to discuss this and much more, I have the Managing Director and Chief Business Officer of Optimus By Afrinvest, Ayodeji Ebo. Thank you very much for joining us on the show this afternoon, Mr. Ebo.
Yeah, good afternoon, and thanks for having me.
Let's now start with our conversation with a play out of trade and especially an investment within the fixed income market and then the equities market at the start of this year, doing an analysis of the first 6 months. And now we've been ushered into the second half of the year as well. We've seen interest rate hikes as well, and to what extent this is also affecting the market. Let's have your thoughts on the intricacies playing out in the equities market and then the treasury bills and bond market as well.
Okay, thanks. Starting with the equities market, I think our market started on a very strong note. And when you look at the year-to-date performance, very impressive, got to as high as 26%. And if you do like a further analysis of that, you would discover that just about 4 or 5 stocks that accounts for 40 to 50% of market cap are the major movers in the market. For most of the stocks, likely for most of the stocks have underperformed in the market, despite their strong earnings. And the main reason why, towards the end of the first half, why we saw the decline, a moderation in share prices, and be attributed to the increase in interest rates. So we saw the hike in interest rates, which signaled that interest rate will move upwards. And based on the correlation of both buckets, as interest rates continue to move up, you saw that the equities market becomes less attractive on a dividend yield basis. And that's, we attribute that to the downside or the sell-off that we are seeing now. So speaking to the fixed income market, we saw that the market started on a very positive note. When you look at the yield environment, it was around the average of about 11-12%. But when you see, despite the anticipation that there would be an increase in yield, based on the expectation that the government will borrow more, also with the expectation that there will be sell-off by foreign investors. So that's we had expected that we would see that translate into increased yields. But the first half of the year, in terms of activities in the bond market, was not really very strong. You will see that rates did not move significantly. When you even look at the last rate hike that was done in May by the CBN, we saw that did not translate into significant movement in yield for the fixed income markets. And the main reason is that we discovered that a non-competitive bid are continue to dominate at the auction, which gives more leeway for the government for them to be able to reduce the pressure on the government in terms of filling their orders. So, but by and large, yeah, we've been seeing this is almost the end of the first month in the second half, and we've been seeing yields trickle up. We know the CBN also moved the benchmark interest rate, that's the monetary policy rate, again by another 1% to 14%, which we're seeing that also translating. Also, investors also in terms of expectation, and we saw that based on the performance, when you do your analysis based on the budget performance, that this deficit would also be very significant. So as a result, that is also impacting on interest rate. And to also just cap it up, despite when you look at the treasury bills market, the rates improves by about 150 basis points after the first MPR hike. But that has not also discouraged a lot of the commercial paper that we're seeing. So we've seen a lot of both private commercial paper notes as well as those that we can assume public that are registered with the FMDQ have continued to issue the papers, which we feel is also positive for the economy. Thanks.
Let's also talk about the perks that exist now, talking about the equities and then the treasury bills and bond market as well now. We're also seeing the Debt Management Office also release the third quarter calendar for this year. And irrespective of all of these interplay, we have to face the reality that this is a heavy electioneering year preceding the year 2023 when we have the general elections all to take center stage. You've made mention of investor sentiment, which are also being thrown up and down here. But what do you think, what will it take really now to woo investors, especially for local players in the country?
Okay, thanks. For the local players, it's going to be a yield game. You look at the interest, you look at the inflation rates as at June at 18.6%, and investors will be trying to see how can they close that gap such that their real return, the negative real return continues to reduce, even if they cannot earn a positive real return. So that's what's going to be in the mind of investors. Secondly, like I mentioned earlier, the budget performance. If we assume the same run rate based on the budget performance as at April that was published last week, we assume the same run rate. That means the budget deficit would get as high as 9 trillion, which is massive. So that also signals that rates are just a matter of time that rates would also improve, would increase, which will be positive for investors. So what we would advise investors at this time is that you should still be playing at the shorter end of the curve and invest in maturities that have attractive yields. They just cherry pick and invest in maturities that have higher yield, but not go significantly long, because we still anticipate that before the end of the year, only a matter of time, interest rates would be up. You see that even the revenue is not even sufficient to cover debt service. So it means the borrowing has to be very significant. The only saving grace, or what may reduce that impact, I would say, is that the support from the CBN, which has been captured as ways and means. So if the support is very significant, then that would reduce the amount of borrowings that we'll see, which would impact on rates. So, but by and large, we expect that the direction will be upwards, but it's only a matter of time.
And for investors sitting on the fence and waiting to see what plays out as well, how do you think this pattern is going to also affect their thoughts at the end of the day? There's some level of cautious optimism, which you've highlighted on, and there are those who are just pessimistic.
Okay, for those sitting on the fence, it's also good to look at the cost of funds. So each day, even if you are not investing those funds, each day you are also losing value based on the inflation rate as well as the depreciation of the naira. So you need to at least look for, if you are unable to cover that inflation gap, you need to at least look for investment that gives you that flexibility for you to take it out. I know for traders, this will not be new to them, or for fund managers. Most times you invest in placement with banks that gives you that flexibility to take out your funds when you see opportunities in the fixed income market. Now, speaking to the foreign fixed income market, the Eurobond. So we've been seeing that significant, for the Eurobond, we've been seeing that significant depreciation in the price, which presents opportunities. We know this won't last for long, looking at our current position. So the investing in Eurobond presents opportunities, also helps you to hedge the naira. We all know what inflow dollars is saying, even in the market now, almost approaching 700 naira to $1. That's the unofficial market.
Yeah.
And that would really impact on the value of your investment. Looking at investing in Eurobond presents that opportunity. Yields are getting to a north of 14%, 15%. We present an opportunity for you to earn return in dollars, as well as hedge your investment against any naira adjustment.
Okay, now as we're wrapping up the conversation, let's also take a look at the treasury bills and bond market in a holistic form now, finally, as we also see the oversubscription. We had 527 percent. That was the overall subscription base for the 1 year tenor we saw for Treasury bills in the month of June as well. Now, to what extent do you think this really also whets the appetite for those who are looking for longer term investments?
Okay, thanks. You know, for most of the investors are trying to, when you look at the Treasury bills market, which is the shorter end of the fixed income market, you would agree with me that the 364 days only active instrument that you have there and move to 7%, and we're expecting that with the 1% increase in MPR again, we may see the auction at the end of today close at between maybe 7.5 and 8%, which it would also be positive looking at where investors are coming from that low of about 4% at the beginning of this year. So, so we believe that a lot of investors will continue to pack funds in that. And for those that want to also go long, that would also impact the rate at the shorter end of the bond market. They would see increase in the rate for the FGN savings bond, which that is accessible to everyone, issued early by next week. That would also, we expect it to increase and also impact on the yield on the bonds market, especially at the shorter end of the curve. So investors should just exercise caution, would continue to see this upward movement. You can also go in branches where you have your funds in placement and continue to take advantage of the increase in yield as time goes by.
So much for your time on the show today. It's been a pleasure speaking with you, Mr. Ebo. And then we keep our fingers crossed to see how the third quarter also plays out. And then as we wrap up the last quarter of the year, 2022, we'll definitely have more of this sort of conversation next time. Thank you once again.
Always my pleasure. Thanks for having me.